let's talk about the rate environment. I think the last time we spoke, certainly at Milken, was a year ago. The rate environment was much different. We were still near zero. We're far from that now, both here in the US and in Europe.
If I'm not mistaken, that was the very same interview you and I were having, an hour after the Fed, and I think that was the tipping point, the tipping moment, when effectively the global capital market started to price a cost for liquidity. And I think that's where we are, right now, and certainly, for longer. Liquidity as the price, and credit as now a value. And so this overall new environment, which for some is surprising. I'm not expecting any rates cut anytime soon, because we know that we have to dry up to a certain extent this whole liquidity that has been thrown in the market.
Have you adjusted your outlook, and more importantly, your models that you use in your investments for the idea that we are going to have higher rates for longer?
Yes, definitely. And I would also add, Romaine, that in this whole debate about recession or inflation, we are adding a third dimension, which is the liquidity. How do you price liquidity when you're an asset allocator like we are, depending on the various markets, public, private, equities, debt, real estate, obviously. And so I think that whoever is nimble today has some flexible capital and is fairly realistic as to the long-term discount rate. If I may say, it's back to corporate finance 1.0. Future cash flow discounted at the risk-free rate plus the risk premium. The risk-free rate is up now, and the risk premium, certainly way higher.
I am curious about that, the liquidity side of this, particularly over in Europe, where most of your work is here. What is the liquidity situation, particularly for your type of markets that you're in? Is it healthy enough to continue making deals?
Yeah, so let me take a very objective example that came out yesterday from the ECB. The bank lending conditions in Europe are back to 2011 levels, which, if you remember, that was post-GFC and then the Euro crisis, so it was fairly tight. So we're back into this environment. Banks, rightly so, are being much more selective. They are benefiting from higher interest rates for their transformation model, but that frees up all space for people like us, asset manager, to effectively be an asset picker, allocate capital where we think, it's not only a right financial decision, but also a proper, impactful, investment. So we're seeing, opportunities. We have to be selective. We have to be patient. I really believe that managers with the real skin in the game will be making the difference, in the years ahead, because liquidity will remain tight in my view.
And there's a concern about how long this lasts. When you have these sort of short-term bouts of disruptions, most asset managers can kind of navigate through that. But if this extends for another year or even 2 years, doesn't that change the equation pretty significantly?
That's why your underwriting assumptions have to be robust, reasonable, if I may say, and really objective, because effectively in our market, in the private market, we cannot sell in, sell out, off a Bloomberg run, from one of your dealers.
Right.
And so this discipline, starting, that's going to be an interesting cycle to deploy now for sure.
What are clients asking though? Because we've seen in certain vehicles a level of redemptions that were allowed at whatever the limit was. But there's also been a lot of anecdotal evidence about investors going back to some of these funds and saying, look, we're just not comfortable, we want our money back. Are you getting those types of calls?
Well, if I may say, Romaine, I think last year I told you that we were coming out of the mother of all happy hours, after this, extensive liquidity. And so people, they wanted to make a 10x all the time, give me 10x in a year, venture, crypto, what have you. I think now what investors are asking us, give me 10% for the next 10 years. I want to be compounding my portfolio. And you can compound that, obviously with credit, with, long-term selected real estate on secondary private credit. So we're seeing more and more of that. The risk appetite has adjusted, but on a contractual, secured basis to create this compounding effect.